Hey, Trader Steven here. It's Thursday morning, October the 25th, and boy, has it been a wild ride. So I just want to get right into it. I want to start with the Nasdaq right here. So we have this trend line. We've had a major bull market trend line going all the way back to the bottom of 2016, and this is from 2015. Kind of have the death cross right here in the moving averages, and the market has gone up, has pretty much doubled from there, almost. Now the Nasdaq from peak to trough was down almost 13%. Yesterday was just a nasty day. Today is bouncing back a little, but look at these corrections right here. You got in 2018, you have a nasty 12%, a nasty 11%, but they all found support at the trend line and at the 200-day moving average. I can't stress enough. Now we have didn't find support, couldn't bounce, broke almost a 3-year trend line, and broke all kinds of support. So I don't know if maybe long term this is a buying opportunity, but it could bounce, and it could bounce hard. But one just needs to kind of keep in mind that when there's uncertainty, you probably need to trade less. Don't watch if you're unsure, if your stock breaks support. Don't sit there and watch it just crater. That is going to drag down your portfolio. I typically take quarter positions in my account, so 25% of each account is going into each position. I'm not telling you to do that, but I can lose, and then I might risk 5-6%. Sometimes it gets away from me more, so let's just say 6%. And I can lose 5 trades in a row, and my account probably would still only be down 10%. I could lose 8% trades in a row, and my account would be down 10%. So if I lost 5-6% trades in a row, my account would probably be down 8%. That's the kind of money management that you have to have right now. There is no reason, in my opinion, for you to be down much more than the overall market, as at least in your shorter term trading account. Longer term, that's a different story. But short-term trading account, once, it started to crack right here, you should have been getting out. I've tried to play the bounce, one bounce. I'm probably down 8% in this 13% correction, so I'm not down as much. And that's about where you want to be. If you have those money management rules, if you can slightly outperform on the upside, or if you can outperform on the upside and definitely outperform on the downside, you're going to be okay. But there's no reason where you should be down too much. If so, I think you're doing a lot of hoping and praying. And, while I have this up, let me show you what hoping and praying can do. Let me show you a stock that was a darling of mine, and I've talked about it many times over. Curo. Actually, let me go to the next chart. So I made some good money on Curo Group Holdings, but it broke the 50-day. Actually, I like the previous chart. It broke the 50-day moving average right here, and I was out. I was out by the end of the day where support broke. So I got out, maybe $28.50, somewhere in there. It's at $17 now. It gapped down 23% on an earnings report. Yes, it's coming back, but God bless. Can you imagine if I still had this thing and I sold it at 28, or I could have sold it at 28, and I woke up and it's $15.50? So earnings so far have not been great, but I think, the jury's still out. I think we still have a lot to go. But it's just something to consider. Hoping and praying how that can really affect your account and, lock it in. I didn't get out of the exact top, but holy crap, man. That's a bad day. Let's go look at another stock that I love. Pun intended, Lovesac. I didn't make any money on this trade, but I got out of it because it broke the 20-day moving average right here. I was out. It didn't do what I thought it was going to do, and now it, gapped down to 1646 from the 23 and change that we got out of because the lockup period was up, so all the owners dumped 200,000 shares on the open market. But my point is, this is a stock I really like, still do. But when a stock doesn't do what you thought it should do, you just need to get out. When there's uncertainty, you need to get out. When you buy something, it doesn't immediately go up, it's okay to just get out, right? So, you know, I'm just showing you these examples, and they're extreme examples, but they're real examples. These are real stocks that I traded, and one I made a lot of money in, and one I lost a little bit in, but I could have lost a lot in both of them. So you have to have rules in place. You know, again, not all markets are just going to come right back, and our roaring bull markets where you just would have been better off holding because it'll come right back. That's why we have those money management rules in place. Now, back to Nasdaq. I just wanted to show you those examples. Back to Nasdaq. It broke all kinds of support. Yesterday might have been just a flush out, just an oversold. If you do have some long-term, you know, like ETFs or something like that to put to work, you know, it might not be a bad idea to nibble at the bottom. But short-term trading, it's tough to buy when the Nasdaq was down almost 4% yesterday. So just keep in mind, you know, when you go on a losing streak, you know, let's take my example. You know, I can lose probably, I mean, I can lose 4 or 5 trades in a row, and I'm not even down 10%. But if I lose 3 trades in a row, my quarter position is now becoming an eighth of a position. I'm taking a half a normal position, right? Because something's not right. One, my trading is off or the market's off. Either way, doesn't matter. You need to cut back your trading, cut back your position sizes until the environment or until you get some wins under your belt. But you know, cash is a position, so just kind of keep that in mind. So the Nasdaq is really broken almost a 3-year trend line, and it's below it. So I'm going to be yes, it'll probably bounce back, but I'm going to be very interested to see how it reacts around the 7,500 level, because what could happen is it could just grind lower. And if you don't think that can happen, you can look at VEU, the international ETF, All World XUS. Has been way down already in bear market territory. You know, look at what happened when VEU broke its 2016 trend line. It broke it earlier this year, and it's just grinding lower. I mean, that is, and then just waterfall, major waterfall. So this is what has happened when international stocks broke their this was a 2.5-year trend line, and it just grinded lower. So yeah, you're going to get the bounce backs, but just be cautious is all I'm saying. And it is okay to, you know, trade an eighth, trade a 16th. You know, if you feel like you have to trade something, maybe you trade smaller sizes. And if you're bull and you get these swings, great. But you know, it's just rough out there right now. So the S&P 500 is really no different. Again, it broke the same trend line, didn't find support at the long-term moving average, didn't really get a bounce. Maybe it bounces now, but again, where this 20-day and this 200-day crosses, I'll be very interested to see how it reacts and if it rejects or not. We'll kind of see how that plays out. The small caps, Russell 2000, boy, that's a bad. This is just, see how much that thing's down. That's almost in a bear market. 16%. That's a waterfall like I've never seen one. You know, don't buy and hold a leveraged ETF because it could be gone very, very quickly. So just kind of keep that in mind. man, that's down, and that's down a lot. So and I'm not showing you to scare you, but I'm showing that it's just it's very important to know that personalities all across the board are changing. What's interesting is no, that's not the one. Is this the same one I was just on? No, I need the CRB. Where did that thing go? CRB2. Well, either way, let's look at commodities. So you have the US dollar, which is the purple line, and that is looking bullish, right? It had a false breakout to the downside, and I mean, that just looks bullish. The CRB, which they typically move opposite directions of each other, and it's looking like that's about to break. This chart looks bullish, and this chart, I mean, you could say this is a cup with handle, but that could pick up steam to the downside quickly, so just be careful in commodities, because right now the dollar is looking more bullish, way more bullish than I would say this is bullish as a cup with handle. So it's something to keep our eye on, but commodities, in my opinion, is not something that you want to be involved when you get that death cross. And it's so simple. It's when the 50-day or the 10-week goes under the 40-week, or the 50-day goes under the 200-day, you probably shouldn't be in it. Just simple rules like that can absolutely save your bacon over time. So now, if we look at let's continue to look at commodities. So this is the CRB, the relative chart to the S&P 500. I mean, if it's going down, it means the commodities have been underperforming the S&P 500, and we're at this trend line. And if it breaks out, that means it could be a new trend for commodities. But man, with the dollar strong and commodities looking suspect to the downside, I would need to see a very definitive breakout of commodities for me to say, okay, maybe commodities needs to be added to the portfolio. Sorry for the noise, it's a trash truck in my neighborhood. So we look at that. Let's look at emerging markets, all things relative. Again, we looked at VEU, emerging markets broke its downtrend line. It's down 26%. I mean, that is a bear market all day long. So international stocks are in a bear market. We'll see what the U.S. stocks are going to do. But I'm not saying that this is going to happen with the U.S. stocks, but that's what happened with international stocks when it broke its 2.5-year trend line. So I'm looking for bullish setups. Don't get me wrong. I'm looking for bullish setups, but I'm also looking at evidence. And evidence right now is telling me to trade a lot less. Emerging markets. Let's look at gold, though, because it is looking a little bit interesting. Until today. Now, I'm shooting this morning. You can see that the GLD right here, it broke. You can say it broke this line, but now we have, a pretty important line right here. It's trying to come back and break back through it. And, if we go down here to the gold miners, the GDX, this is looking pretty bullish. Yeah, you have a breakout, a bull flag. I almost took this trade. Here's why I didn't. If you look at it a little bit closer, like if I can blow this up, let me move this over. Actually, that doesn't look good at all. But my point is, what I was noticing in this bull flag is it kept closing in the lower end of the range. Like even when it gapped up a couple days ago, it just closed down. So breakout failed. In my opinion, this could probably potentially take another leg lower. Something to keep an eye on. But gold, to me, I probably just going to roll back in here. So you have the GDX, the miners versus the metals relative ratio, and it started to outperform for a little bit, and it's just looking weak. while the dollar is looking incredibly bullish. It looks like it wants to get out of this bigger consolidation and take another leg higher. Market breadth. Let's start at the big picture and then I'll go smaller. So 32% of stocks are above the 200-day moving average in the S&P 500. That is bearish activity. Just because it's just because say bearish doesn't mean bear market, but that's bearish activity. You know, a thrust above 60, according to Arthur Hill, stockcharts.com says it's bullish, but breadth is weak right now. We got a little bit of a bounce in breadth. You can see right here, and then it's absolutely rolled over. So I would be surprised if it just comes right out of here, because if we look at the last one, it chopped around a little bit, made a nice rally, and then kind of rolled back over. So expect chop, you know, even if we get a bounce, don't expect a V-shaped recovery out of this. 15% of the stocks in the S&P 500 are above the 20-day moving average. Could easily run a scan on any scanner. What's still trending above? I'm going to give you a hint. Probably a lot of utilities and defensive sectors. So if we look at the high-low breadth, so let's just go down here, the S&P high-low breadth. Look at another breadth indicator. Look at all the selling pressure in the S&P, in the mid caps, lots of selling pressure, and small caps, the Nasdaq 100 yesterday. And yesterday could have been, you know, just kind of an exhaustion to the downside, you know, due for a bounce, but I don't know. I'm just going to kind of keep my eye on it. I could probably keep a lot of my powder dry. But if we go back and look at the S&P 500, let's see what, so we have 15% of stocks in the S&P 500 are above the 20-day moving average. Technology, 4%, so that's weak. Financials, 3%. Discretionary, 6%. Industrial, 0. That's not good. Healthcare, 1. It looked like healthcare was going to be out of this, but, you know, weak. Staples, 59%. Those are defensive stocks. Energy is weak. It says 0. Maybe there's 1. I don't know. Materials is weak. Utilities. The utilities at 90%, the staples at 60% are what has making up this 15% of the market trending above the 20-day moving average. So the breadth is weak and the money is clearly flowing into defensive stocks. So we have to keep everything in mind right now, looking at all the evidence. What else do I have on my list? Let's look at the dollar. Again, you know, the US dollar, this is the weekly chart. You have a breakout of a head and shoulders, a false breakdown, a cup with handle. This looks as bullish as can be, which should play better, which should continue to put downward pressure on international stocks, emerging markets, meaning if you have to be invested somewhere, I think that the S&P 500 is probably where you want to be. But small cap stocks typically do better when in a bullish dollar, but just is not doing well, as we already saw. They are 16% down. It's been a straight leg down. So there's not a lot of places to hide right now, except the way I see it, except for cash. I'd rather be in cash than utilities, because you know, if the market's that bad where I have to own utilities, that 2% dividend in the utilities, and that can be wiped out in a half a day. So just kind of keep that in mind. So let's look at the VIX. So the VIX is falling today, but it's above 20, and one could make the case to not trade when the VIX is above 20, right? It's hovering in the zone, it's spiking. If we look at the S&P 500 to the downside, you can see that, you know, you have these spikes, you have these legs down. Maybe it does come down and the market does bounce a little bit. We'll just see, but you can kind of see these spikes in the VIX. If you look at this, you can see this first leg down, this spike was the high, but the next leg down, the VIX didn't get up there quite as high, which is a positive divergence, meaning, you know, money could flow back in, or it could have been a bottom. So right here. Now if we look at this leg right here, you can see it got to 25 and then it took another leg down. It got just a little bit higher. So there wasn't, in my opinion, a positive divergence. Now it was close. And I still think the market can bounce from here, but you just really need to be cautious when trying to play this. I don't make investment decisions on the VIX, but I have this purple line above here just to kind of show you, you know, if you look at the chart below, it's just a lot tougher. It's a lot tougher because you can see when the VIX is above 20 in this upper chart. Look at the chart below in the S&P 500. It is just a choppy market. You know, same thing right here. The VIX is above 20, and then it doesn't always stay above 20, but it's just kind of more evidence to show you that it just kind of continues to chop around. Kind of interested to see what bonds do, because, you know, bonds, they try to break out as a false breakout. So you kind of clear this double bottom right here. Let me get this inspect off. But it's interesting because, you know, if I look at this, bonds sold off before stocks, just a little bit, maybe a week or two before, a couple weeks before, and even bonds are down. You know, we're down 8%. You know, for a part of your portfolio that's supposed to be conservative. Even a diversified portfolio in 2008 with bonds and everything was probably down 35%. Most of them were. So you just kind of got to keep that in mind, that sometimes what seems to be conservative isn't. Let's look at some major S&P spider. No, actually, hold on. Let me kind of go back a little bit. Come on. So let's look at the spider ETFs. And I want to look at 10 per page. I just kind of want to scroll through these real quick. Just see if there's anything above the 200-day moving average. Discretionary is down. Technology is looking really weak. Industrial, that was the one with 0% above the 20-day moving average, does look incredibly weak, and has already broke the May low. Materials is by far looking the weakest, which makes sense because gold kind of is breaking down today. Energy, you have energy that's breaking down, is below the 200-day moving average. Consumer staples, I mean, if that chart looks kind of bullish, you know, you kind of have a pullback, maybe you call it an ugly cup with handle, looks kind of bullish, but it's above its 200-day moving average. But to me, I just rather be in cash, because when the market sold off here, staples sold off with it, even though it has bounced back. Healthcare is above the 200-day moving average, is trying to hold. We'll keep an eye on that because it had the best trend in the last several months and has been showing a lot of strength. Utilities yesterday hit a 52-week high, or at least in this chart. So, you know, again, if you're looking for a place to hide, maybe it's utilities, but I'd rather just be in cash and wait for a signal. Financials undercut all these lows and is incredibly weak, regardless of interest rates rising. So again, there's just not a lot out there that's looking good. Looking at the weight of the evidence, I do want to show you something. You know, you can always look at kind of a momentum-based strategy, and this is something. Let me kind of add a lot of things on here. RJI. Let me add TLT. And then let's go back here. So, you know, sometimes a momentum-based strategy is really good, and I do use these with a 12-month look-back period. If you're looking for something incredibly simple, and you just own the strongest in the last 12 months, you look back 12 months. It's momentum-based, so you know it's just like Sir Isaac Newton. Something that, you know, starts in motion stays in motion. I think I quoted that right, but. Anyways, you look at the last 1 year, and you can see in the last 1 year, international stocks are down 9%, a little bit, 9.73. This is 252 trading days. Bonds are down 4.1%. This is with dividends. S&P 500 in the last 12 months is holding on to almost a 4% gain, so it's up. And honestly, this RJI, which is a commodities ETF, is doing the best at 6%. So you have bonds. You know, this is kind of the four sectors, right? You have U.S. stocks, international stocks, bonds, and commodities. Even though commodities is looking really, really weak and has sold off too in the last 12 months, this RJI has actually, and this is an ETF, Jim Rogers Commodities Index, it's actually done the best. So I'm not telling you to go out and sell S&P 500 and buy commodities, but sometimes it's just interesting to look at. Now they've crossed a little bit, so I'll be very interested to see, you know, as you know the month continues, if this relationship continues to move in that direction. Okay, so if we're looking for things that are bucking the trend, at least as far as sector goes, you know, I track about 250 individual ETFs. I put them in a list, and I rank them by 3 month. And the reason why I rank them by 3 month is because I like to see, you know, what is starting the trend to try to catch it a little bit early. Sugar is actually kind of interesting. You can see right here. That it has, now it's extended, but look at all this accumulation starting to step into sugar. I wouldn't buy it right here, but you know, maybe it pulls back a little bit. Another thing that I've noticed is Brazil. Brazil is on the cusp of an election. It could go one way or the other. I think that there is one very much pro-market, free market president that the markets want, so we'll kind of see how that goes. But you can see that not only has Brazil not sold off, it is just this relative strength line is rising. So it's just kind of something to keep an eye on. Maybe there is a catalyst. Now, if you look on the weekly chart, this thing really doesn't look good. It's the 10 week is under the 40 week, but it's looking kind of strong. So you know, just a couple industries or a couple ETFs to kind of keep the eye on. And there for a minute, you know, again, miners were looking good, and now they're just kind of rolling back over today. So I'd be interested to see if this finds support or if it just absolutely kind of goes back into a bear market. We shall see. But you know, right now, at least as far as my list, my watch list, it is ever so shrinking every day. And I'm adding a few to it, but as stocks continue to look ugly and not find support, I'm just heaving them, you know, and just trying to manage the list of the strongest names out there.